different from all other banking solutions. Bank Like a Bank is different from any other banking solution in the market today. Bank Like a Bank is not only different from infinite banking, be your own bank, become your own bank, bank on yourself, or family banking, but the goal of these strategies is not the same. One is about using life insurance as a bank to finance consumer goods. The other is about canceling interest by paying debt early, overfunding the policy, using that debt to build income and generational wealth. Unlike BYOB or infinite banking, with Banking Like a Bank, people can borrow against their debt, earn interest on that debt, during and after the debt is paid, without tax and without paying back the loan. Banking Like a Bank was only possible after the IRS Code 7702 and 101A, passed by Congress, changed in the CARES Act 2020. Bank Like a Bank was researched, developed, and implemented by Ron Harris, the CEO of Financial Literacy Group, in March of 2021, and the Bank Like a Bank app was released in April 2023. Bank Like a Bank is a unique combination of GPS debt technology and a special kind of liquid index universal life insurance. This solution is too new for most agents or advisors to offer or talk about, and with all the noise out there about life insurance, it is too new even for influencers. So as a certified financial planner, CFP, not knowing about this means they really don't know about all the solutions that are available. The goal of Banking Like a Bank is not to use the whole life insurance policy in your personal bank. The goal is to strategically optimize your debt payoff using technology, eliminating up to 75% of the interest, while paying off your debt or mortgage in less than 5 to 7 years without changing your budget or lifestyle. Not any or every whole life policy will work here. The strategy only works with a bank-owned life insurance, BOLI, type of policy, or private-owned life insurance, POLI, has no surrender charges, no caps, and no fees. Regardless of what advisors say, equity is real money. With amortization, a 6% APR on a mortgage equals more interest than the cost of the house itself, and losing money in the stock market happens every day. Bank Like a Bank is a type of hybrid arbitrage that deals with any kind of debt, including credit cards, residential and commercial mortgages, auto, equity, personal, student, equipment, and business loans. Rather than using a HELOC or savings account as an offset account, using the Index Universal Life Insurance policy allows the user to make tax-free income on their early mortgage or debt payoff. The money a person uses to pay their debt never leaves the IUL. They earn tax-free interest on their liabilities for the rest of their lives. Policyholders have little or no risk because they are receiving the return from the indices that would normally go to the life insurance company. Homeowners or debtors make the interest on their past and future loans and never pay them back. Bank Like a Bank actually equalizes the financial playing field and closes the wealth gap forever. How do banks, credit unions, and other organizations in the finance industry use tax-advantaged products to offset costs? Bank-owned life insurance, BOLI, is a great way for banks to save money on their employee benefit costs without adding expenses on a monthly basis that take away from bottom-line profits and mask bank performance in their financial statements. Bank Like a Bank duplicates this. There are a lot of influencers online and on social media talking about the benefits of life insurance, mostly whole life versus IULs. They speak about borrowing money, buying consumer products, and in most cases, paying back the insurance loan. When it comes to IULs, they speak about the fees, cost, the 0% floor, the volatility, and the compound interest. They don't talk about surrender charges, caps, and that you can overfund the policy with your debt, which in this situation becomes the debtor's collateral. Why? Because surrender charges could be 10 years away. They consider debt another subject, and overfunding means having to put more money in the policy. Overfunding the policy with your debt, liabilities, or mortgage is actually less money than the user would spend because of the reduced interest the GPS debt technology delivers. Users don't pay back the loan, they are borrowing against their own money, which was originally their debt. Liabilities are the collateral, not the death benefit. That's why Bank Like a Bank is different from any other banking solution in the world.